about the AI bubble warming. Is the stock market heading for 2025 crash? That is the question, and I'm going to answer that question for you. Number one, do not panic. The AI bubble is not ready to burst. One. Two, the market is now more expensive than it's been in the past, but it is not as expensive. Let us start. Do not panic. The AI bubble is not ready to burst. The market is now more expensive than it used to be. That is sure, but it does not mean that it's a bad thing. Okay. What I want to say to you is this: you can afford to make a mistake right now because the market is very overvalued, but does not mean that it's the end of the world. So what am I saying to you right now? It's important to understand that the AI is very different than the dot-com bubble. They will tell you that there's a bubble coming, the prices are high, be careful, get out of the market. No, do not go for that type of thinking. What you want to do is you want to understand what happened in the past. That's what you want to know. You want to understand, what went on 20 years ago, right? In 2000, this is when everything went south. Okay, 20, 25 years ago. What do we mean by that? Well, let us compare the AI today versus the dot-com of yesterday. What happened? Well, first of all, you need to understand this, that it was a very, very different market. There was a difference between today's AI boom and the dot-com bubble of the late 1990s and early 2000s. First of all, it lasted from 1995 to 2000. That's the dot-com bubble. And at its peak, the Nasdaq traded at 120 times earnings. The AI boom, which started about 2022, versus to today, 2025, is about 3 years old. And the capital is flowing into AI startups and public AI-linked companies like NVIDIA, Microsoft, anything like that. But the valuation are anchored on tangible revenue growth. This is not the same thing. When we looked at the dot-com bubble from the 1995 to 2000, I want you to make sure that you understand that there's a big difference. At that time, they were trading at 120 times earnings. Today, it's trading at 25, 30, and they have tangible revenue growth. They're making money. So it's not the same thing, okay? Do not let them tell you that there's a bubble, you need to get out. This is what they do usually when they want you to get out of the market, so they pick up the slack and pocket their gains. Okay, you want to stay in right now. Okay, the capital inflow and valuations are in favor of the AI boom that's happening right now. Second, in terms of technology readiness, you need to understand that the dot-com bubble, the infrastructure wasn't fully mature. It wasn't. They had a bunch of dot-com companies, but they were not really that mature. They were doing a bunch of different things that didn't make too much sense to begin with, but they had a dot-com at the end of the word, and that's how they made money. While the AI infrastructure exists. There's GPU, there's cloud. It's much more solidly ingrained into the system. There's more of a product. There's more of a future. There's more of a tangible aspect to the AI structure. Third, in terms of the winners versus the hype, 80 to 90% of the companies at the dot-com era went bust. Poof, disappeared. There was nothing left. While in the AI, incumbents are driving the boom, which reduces systemic fragility, not just startup. We're not just, picking a company come, I think it was like pets.com, I don't know if you remember, and pets.com here. No. We have companies that are incumbent, companies that have, for example, you've got Microsoft that's out there. you've got Nvidia, and they are incumbents, and they have something to show for it. Very, very different than the dot-com bubble that used to the bubble dynamics. Number 4, at the dot-com bubble, the Nasdaq fell 78%. I mean, not in one day, but over 2 years. Recovery took over a decade. Here, the AI boom, if there were to have a crash, or it's concentrated on a few names, a few mega cap stocks, the Magnificent Seven. So I want my subscribers to understand that. I want you to learn and see what is actually happening. And what's happening is a very different ballgame. Just because they're saying, oh, it's the AI boom, what are we going to do? No. It's not like that. It's not really like that. It's not exactly the same thing. You need to understand the difference. There's a big difference. In terms of macro context, the dot-com era of we had falling interest rates. We have cheap credit. It was easy to get things done. Now you're doing it despite higher interest rates. So you got to think twice or 3 times before you start raising money to put together an AI company or AI investment or AI future, right? It's a little more complicated, and you have to be more careful, which is good. You want careful right now. You want careful. And the reason you want careful is because you have to be careful. Right? Because we don't know where it's going to go. We know it's very expensive, and we keep thinking .com, but it's not the same thing at all. And frankly, the internet adoption went from 20% in terms of adoption curve, like who used this thing? Well, it went from 20% to 70% of the people from 1997 to 2007 using the internet. So it was a lot of people using it. It was a very big adoption. While tools like ChatGPT reached 100 million users in a month, but monetization is still shallow. So basically what we're saying is they were everywhere right away, almost everywhere. While here, there's still more room to grow. So what do we have? One, we have low valuation compared to what we saw in the past when we talked to .com. 2, the technology today for AI is much better, much stronger, much sterner. There was a lot of winners, but all of them disappeared. So the companies are stronger. The dynamics are different. In terms of micro context, we have high interest rates, which makes you to be more careful because it costs more money in terms of you raising funds. That's the big difference, and that's what you have to be careful, right? So that's the first point I want to make. That essentially, let's not take a look at this as it's a .com and no. What I'm saying is, don't panic. Number 1, don't panic. There is no bubble. There's no AI bubble. I know last week, one of the AI ChatGPT guys, Altman, came out and said, well, there may be a bubble. First of all, what do you mean by a bubble? Is it too expensive? And I will show you in some certain aspect it is expensive, and I will show you. But basically, don't panic. The AI bubble is not ready to burst. Right? The market is now more expensive overall. We really can't afford a mistake, but it's not just the AI mistake. It's tariff mistakes or geopolitical mistake. That could be an issue. Not everything is expensive in the market right now. Not everything is expensive in the market. In fact, for my members, I do review the market every day and explain to you what's going on, and also make recommendations. My recommendations are doing very well right now. I'm recommending a lot of small caps, gold stocks, also stocks that have to do with rare earth minerals are going to be growing quite a bit. So it's not everything is expensive. Okay, so get that out of your head right now, because that's not the case. It's not so much that the market is overvalued, but it's just that certain portion of the market is overvalued. Then don't buy it. Buy what nobody wants to buy. You make money in the stock market when you buy what nobody else wants. Don't run after, well, I gotta get in there. No, don't do that, because that's not gonna be great. So in terms of the valuation themselves, right? In terms of the valuation of the stock market and more importantly of the dot-com versus AI, let's learn something today, right? Let's take a look at 3 ways of valuing stocks. The first one, PE ratios. Well, the dot-com, 1999 to 2000, the PE ratio was around 120 times earnings. The AI right now, 25 to 30. So in terms of a PE ratio, there's no overvaluation here. We're nowhere near the AI time. Now, if you look at another way of valuation, which is price to sales, there the median was around 20. So basically, how many times sales you're willing to pay for the stock price. It was around 20 to 30 times with the dot-com era. Right now, okay, fine. NVIDIA is 35 times sales. So NVIDIA is expensive. But Microsoft is 13 times, Meta is 7 times, and the S&P is 2.5 times. So we are nowhere near. In fact, anytime you hear someone tells you there's a dot-com bubble and the market drops, you buy. That's exactly what I did. I bought yesterday and I bought last week. You want to, and I show that when I'm actually buying in my for my members. Every day I post you. I want to keep you up to date as to what's going on with the market. Now, number 3, market cap, which is the value of the stock, to GDP. There, which is what we call the Buffett, the Warren Buffett indicator. There, I would say that there may be a bit of a problem because if you look at the U.S. market cap to GDP, for the dot-com era, it was 150 times. Today, for the AI boom, it's around 180 to 200 times. So there, I would suggest the market is historically expensive. That's probably where it's coming from, like the market is expensive. Whoa, we got to be careful. Maybe that's where it's coming from. Number 4, the IPO and venture capital activity. Well, in 1999 to 2000, there were around 400 IPOs per year. Here is a lot fewer IPOs, so they're more careful. And in terms of market concentration, the dot-com, the NASDAQ was dominated by many mid-dot-com IPOs, fragile balance sheet. It was tiny companies. They didn't know what they were buying. They were, pets.com. That was the last one. And then everything collapsed after that. The AI boom is basically 7 stocks, really. That's what we're talking about. NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, and Tesla. And they're driving 60% of the S&P gain. You need to realize that when we say the stock market is going up, we're really referring to the S&P 500. Because how do we know it's going up? Well, we have to look at indices, right? The Dow is one, but that's only 30 stocks. In fact, last week, when the S&P dropped because of what Altman talked about, the fact that there was a bubble in the stock market and with the AI stock and the market dropped, the S&P dropped, but the Dow didn't go anywhere. That's right. So, and the S&P is really those 7 stocks, the AI stocks. This is what we're really talking about, just 7 stocks. We're not talking about the entire market being overvalued. So, 7 stocks. Concentration is higher today, which can magnify correction if AI expectations falter. But if you don't own the S&P, you don't have these stocks, you're not going to be hurt that much. And that's why I recommend my subscribers and my members to move to the small caps. Companies that have less than $2 billion in market capitalization. 1. 2. Companies that actually have growth potentials. They're growing already. 3, companies that have no debt, because the issue with the small caps is they tend to have not good earnings, and that's why people don't like the small caps. I'm not asking you to buy all the small caps in the world. I'm asking you to buy the better small caps, the ones that are more profitable, right? So essentially, what happened on the day of the crash? Was there a crash in 2000? When the dot-com bubble? Well, there was no crash. Basically, what happened on March 10, 2000 is widely considered the peak and turning point of the dot-com bubble. On that day, the NASDAQ composite hits an all-time high of 5,000. In the week that followed, it began a steep decline, losing 10% by mid-April. The broader collapse stretched over almost 2 years, from March 2000 to October of 2002. So it was just a slow death where you lost 70% of the value. Why did it crash? Well, overvaluation was one. Interest rate hikes were another one. Collapse of key player like pets.com, boo.com. Shift in sentiment, feedback look. It says, oh my God, what have we done? This is horrible. We're going to lose our money. And let's get out because we're overvalued. And you were overvalued at that time. Now, you need to realize at the end of the day, forgetting the dotcom situation and the crash, what caused stock market crashes to begin with? Well, if you look at history, what causes stock market crashes is basically a recession. It's really financial stocks, contraction of money supply, big shift in fiscal tightening. And we're nowhere near, right? You need something, and you need a big surprise. At the end of the day, what you want to do is you want to make sure that you understand what you're buying and you understand the hype. And what is the hype right now? They're telling you that AI bubble is going to burst. What AI bubble? AI is 7 stocks. Okay. The number must be so small, we value your opinion so much. I would say this. Everyone has its own opinion in terms of what they think is happening. And in 1987, when the stock market crashed by 20% in one day, that was a one-day crash. That was a crash. I mean, the AI was a bust. It took 2 years to collapse completely. But 1987, that was bad. And you know what they did? They went out and they asked 1,000 traders, why did you sell on that day? What caused the stock market to crash? What happened? And you know what? They didn't know what caused it. It's human condition. The people do not know exactly what's driving them. And you're right. Right? People are so attached to their opinion. But what percentage of opinion do you think actually changed the world for the better, according to John Jacob Smith? You need to know the facts, because what this channel is about. This channel is about understanding the facts. This channel is about understanding what's happening. You need to learn from some things. You can make the right decision. Otherwise, what are you doing? You're just receiving information and taking advantage of. They're telling you, be careful of the AI bubble. You're going to lose your money. Get out of the stock market now. No. Every time the market drops, there's an opportunity to buy. But what about the economy? What about the stock market? What about the tariffs? What about all that? Well, understand what's happening. The economy right now is growing at 3.3%. Nothing wrong with the economy right now. What about the tariffs and the fact that the inflation and prices are going to go up? Stop right now. Okay. The tariffs, first of all, will impact the companies that are importing the stuff. It's not going to impact India and China and these people. If you're Ford and you want to buy aluminum for your cars, you're going to be paying the tax, the tariffs. It's up to you to decide whether or not you want to have the consumer pay for it. You decide. And they're saying, well, they're going to pass it over and it's going to create inflation. Stop. These tariffs impact not every single companies in the U.S. It impacts about 20% of the GDP of the U.S. because about 20% of the GDP in the U.S. is all about industries. In fact, it was higher, and that's kind of what the government's trying to change, but it's been dropping and dropping and dropping and dropping. We're producing less and less and less. So you don't make any money? No, the U.S. is making lots of money. The U.S. is 25% of the GDP worldwide. They are making money, but not on industries. They're making money on services. So those tariffs, you know, it's only for 20% of the industries. And when you talk about which industries are reflected in the stock market, in the S&P, it's about 10%. So you're not going to have a crash because the tariffs are going to... No. You could have a crash related to the tariffs because the uncertainty and the noise. There was because what happens is the market hates uncertainty. That's why in April they said, "Oh my God, 100 you're going to tax 100. What are you doing? 100 countries? I didn't price this in." They priced it in. The market dropped, and they realized what was going on. They understand, like I'm doing right now with you. They learn, and then the market just recover because they say, "Well, hold on, this is not such a bad thing." I mean, yeah, but these people were making money to begin with, and they're going to pay a little bit more, and then inflation was going to go up at some point. And because you have to understand, this whole tariff situation is a very controversial issue, and because of the it's polarized. Everybody's polarized on it, and you don't know what's going on, so you panic and you say, "Oh my God, this is the end of the world." No, stop. It's not what's happening. Okay. What's happening right now is the economy is doing fine. Unemployment is at 4% or so. This is great. This is almost full employment. But the job numbers are bad. Yeah, they weren't that strong. That's true. And on top of that, that's probably why you're going to get some rate reduction come September. But understand also that, yes, not many jobs are being created. But a lot of people are not looking for jobs because there's a lot less people, had to leave the country based on there were 2.6 million people joining the workforce, right? The only thing is from this country, but 1.6 had to leave. So really, that's what you're keeping the unemployment low. Now, of course, it's not a good thing going forward because if you're getting a lot of people, who's going to be running the country at some point, and who's going to be paying your social security? That's the thing you have to worry about as well. So it's not all honky-dory. But at the end of the day, if I'm looking at the numbers right now, 4% unemployment. Are the tariffs a bad thing? They're going to destroy everything? Well, hold on. Not seeing too much inflation right now. In fact, the Fed itself said, well, let me focus more on employment than on inflation. Okay. I know there's a lot of noise, a lot of decision, a lot of people doing a lot of crazy things, but you got to know what's going on, so you need to understand what is happening. Okay? And frankly, everything seems to be okay right now. Now, the big question right now is, it's the uncertainty about everything, because you see, if I don't know how much I'm going to charge, how much money I'm going to charge the tariffs, the companies, right? And how much, if I don't know what to do, because don't forget the tariffs, especially right now with the government is doing, they're shifting away from emergency tariffs, which is not going to work. They're going to go to the Supreme Court and they're going to say, no, you can't do that. So what they're already shifting to security tariffs, meaning that I'm going to tax India 50% on the steel, because I need steel to be built in this country, because I need steel, to make weapons to protect the countries. We can't have everything coming from other countries. So for that, they'll get away with. They'll allow them to do that, and the Supreme Court can't do anything about that. Okay, security is different. There's three types of tariffs: emergency, and then the security. Emergency, that's not going to work. Now, security also has to do with the semiconductors. In fact, very recently, the administration is preventing Taiwan Semiconductors from exporting its chip to China, because they're concerned that we're helping the quote-unquote the enemy. I don't know. I mean, is it the enemy? What's going on there? It's getting a little rough out there. I'll make a live on that, but it's getting a little rough. You've seen them all getting together, China, India, and Russia. That's fine. They could do whatever they want. I mean, they want to make their country great again, but they're getting very close together, and the U.S. is getting apart. Is it because of the tariffs? let's not be naive. I mean, this was happening way before. Look at some of my previous videos and my live, and you realize that, India and China have been talking for a while now. This is not new. This is not a big surprise. What's going on, and that's what you need to be aware, because if you're not aware, that you don't understand what's happening. It's not that India was driven, maybe they had decided already, and this is just what's happening right now. Anyway, okay. We have a question. Who will make profit in the short term? This is probably the answer that makes the most sense. Everything else would just be a side effect. Who is going to make a profit in the short and long term? Well, at the end of the day, the people that are going to make the money, it's the same. It's the same companies. The same companies are making the money. And the tariffs, it's impacting Ford, it's impacted GM, and it's impacted Levi's because they have additional costs. Well, they got to import the steel. Maybe not Levi's because they're importing the material, but that if it's not an emergency, they're going to have to give the money back. That's going to be a disaster. But the question, the more fundamental question around the situation, the tariff, is the fact that because you are importing so much money and you have to give it back, the concern is that, well, but does that mean that I have to give the money back? So therefore, we're not going to collect $300 billion to help pay for the deficit? No. That's going to be a problem, and that's what that hurt it a bit. But so back to this story on the AI boom and all that, I would not worry too much about it because there's not much there. I mean, at the end of the day, that's what we're saying. Now, having said that, let us talk about something else. Let us talk about what happened yesterday. Having to do, since we're talking about the tariffs, right? Let's talk about what happened with the tariffs yesterday. And we had Peter Navarro, and he was out there, talking about some interesting topic, right? And he was very upset. He was very upset because he's basically saying that U.S. trade advisor warned blocking U.S. tariffs equal the end of the United States. What does he mean by that? Well, basically, he was interviewed, and he was a bit rude, I have to say, towards India and the way he was addressing himself. And basically, what they're saying is, I think they're talking to the Supreme Court. They're talking to the Supreme Court, and they want to make sure that the Supreme Court, they want to make sure that the Supreme Court does not nullify the tariffs. I mean, because at the end of the day, that's what you're talking about, right? They want to make sure the Supreme Court does not nullify the tariffs. And chances are they will. They're gonna file. You have no choice, because what the court does not want is, they do not want you to decide in there's the Supreme Court, by the way, for you. They don't want you to decide in such a way because they feel that it's too much. They feel that you can't decide in such a fashion, such a way, what's going on. That is not what it's about, right? They basically want to make sure that the U.S., that the government doesn't act in a unilateral way. And when Biden last year basically was saying, you know what? No more, what was he saying? No more, we're not going to, the student loans, I'm going to forgive all of them. He said, you can't do that. You cannot do that. You don't have that kind of power. You need to go to Congress for these things. You don't have that type of power And the same way with the tariff. Just because you say it's an emergency, no, that's not good either. You can't do that. And of course you would say, well, look at the courts. Well, as you could see, there's 3, 6, 9 people there, right? And these people, 3 of them was put on by Trump, and another 3 came from a previous. They came from a Republican administration. Still, it doesn't mean that they're going to vote the way you want them to vote because of their party affiliation or who put them there. They put them for life. They don't have to listen to you. They could do whatever they want. And what they're going to do is they're going to say no. They're going to say no. They're going to say no. Those tariffs are illegal. And the likelihood is high. I mean, on August 29, the Federal Circuit ruled 7-4. Basically, that decision is grounded on the major questions doctrine. That's what it's about. Meaning that if a president takes sweeping economic actions, Congress must have clearly delegated the power, and these are sweeping decisions. And they're saying that it's too sweeping. You don't have the right to do that. So the high likelihood, we're talking 70-80%, and that's why Navarro came out and said, "This is the end. We're going to crash." And well, the reason the market could crash is it's not so much because of AI or anything like that. What the issue is that they were expecting to collect about $300 billion. And that $300 billion would make a big difference. And don't forget to subscribe to the channel. That would make a big difference. That money would have made a big difference. And I don't think they're gonna see that money this time around. And because they're not gonna see it, that's gonna be a problem. That's all. I mean, it's not a big deal, but it's gonna be difficult for them to get it approved. So where do we stand with this? Well, the way you stand is you're gonna have to give the money back. You have to give the money back. You have no choice. How much money you have to give back? Well, about $170 billion you have to give back. Because that's how much it's going to cost. And that's why Navarro came out and he was very upset. He was upset because he said, it's the end of the world. What? We're going to give back the money to all these people? Yeah, you have to. We're talking $150 billion. And right now we're collecting still. And that money was going straight for Treasury. No more. It's not going to Treasury anymore. It's going bingo straight back into the other countries. And that's a problem, right? Because that's going to be very unsettling for everyone. It's going to be disturbing. They're not going to know what to do with it. The bond market is not going to like that. They're not going to like the fact that here we are doing this thing, and you were giving the money back, and we did all these things for nothing. How could that be? How could we do all this for nothing? Now, when you go back to Europe or China or Russia, you're going to look stupid because you're going to say, well, why are we talking to you for? We shouldn't be talking to you. We should be talking to someone else. Right? So that's the issue. And the refunds, of course, there's $47 billion already on the books. They $47 billion collected between January and May, so you got to give that money back. And by October 14th, which is the deadline that they have, it's going to be even more money, and they still keep on collecting it. And then in the middle of all this, you've got China and India and Russia. They're getting together. They're showing a bunch of weapons. And then Trump says, I don't know, something about you betraying me or whatever. It's going south, but it's going south from a global point of view, from the way, looking at countries and the way they're operating. that's going to be a problem for them to deal with. And you're losing ground. Well, unfortunately, you're losing ground industrial. The U.S. is losing ground from an industrial point of view, right? And that's why they're trying to bring it back. The only 20% of the U.S. is doing industrial, and then you're doing less and less otherwise as well. So you need to circumvent. You need to do better. What do you And then they're all getting together. And then of course September is going to be a tough month. September is going to be a tough month for the U.S. because you got the Supreme Court decision that you need to, October 14th. You have until not the decision, but you have until October 14th to bring up your case. Then you've got Trump gave a deadline to Russia to say, okay, you got to stop this thing with Ukraine. Remember, he was going to give 90 days and he was going to be very tough on them. 3, you got the budget deadline that needs to be discussed. That's going to be a lot of damage too. The Democrats are going to say, okay, now you need us. Now we're going to get back to you. Now we're going to discuss, right? And then 4, there's the Epstein file, which we're going to be talking this afternoon. They just released 30,000 pages of stuff. So all these things are coming together right in September. And I have to tell you that September has not been the best month. In fact, has been the worst month for the stock market. Okay. So something to worry about. And then, will history repeats itself? The red line is basically inflation today. Right? And you could see it's going down, right? But the white line, some of you might remember, the white line below is basically inflation in the 67 to 19 from 67 to 1983. And you see what's happening, right? It's moving together. They are moving together. And now, technically, does history repeat itself? We shall see. If you may or may not remember that in the 60s, because of the war in Vietnam, that caused a lot of inflation. We were spending a lot of money to build weapons. And inflation went up. And at that time, Nixon told Arthur Burns, which was the Federal Reserve Chair, lower the rates. Does it sound familiar? Lower the rates. I need lower rates. Does it sound familiar? And the only thing is, at that time, Arthur Burns said, okay, fine, I'll lower the rates. And of course, and you could see that white line that starts sticking up, in 1972, 1973. Remember those days? And the market the inflation just shut up. And then it went down again. But then they lost control of it, and it went back up all over again. And they're concerned that here you are again. We're talking inflation. Is it going to happen? Is it not going to happen? We shall see. But we're talking inflation and we're talking lower rates. That is a bad combination. And I want my subscribers to understand that. That is a risk. And if history repeats itself, they see that white line underneath? That's us today. We're going up. And the only way then, that's going to be very damaging. Forget the AI boom. That's what you need to worry about. Because if the rate starts going up, right, because they're going to have to make it go up. And in fact, looking at right now, if you look at some of the treasury yield, they're kind of getting nervous. And they got nervous because of those tariffs, not so much because of the inflation or tariffs and none of that. They're getting nervous because the government thought they were going to collect, and the rating agency thought they were going to collect $300 billion of tariffs. That goes directly. It doesn't matter who pays. It's a tax. It doesn't matter. The point, it goes straight for the Treasury. And you say, you see, every year we have a $1.5 trillion deficit or so. Well, this helps towards the deficit in a big way. But now you don't have that anymore. Right? So, and then they start to look around and they're saying, well, you have lots of debt. And UK has lots of debt. Their rates are going up. And Japan has lots of debts. And Europe has lots of debt. What's going on with government debt? This whole world is awash with debt. You are printing too much. You're borrowing too much money. That's not good. And so if that story takes hold and they start to look at the debt, they're going to look at the U.S. at $37 trillion, which is which is manageable but not sustainable, then they're going to start looking at the whole thing like, oh, the market is overvalued, and then it's going to crash. That's how it's going to happen, that way. So right now, we have to be very careful that we don't get any type of inflation. Now, are we going to get inflation? Well, it depends how much, but yes, you're seeing some prices increasing, but remember, it's not across the board, and it's only with the industries right now that are getting hit. Now, of course, if you have a contamination effect, meaning that, well, everything is getting more and more expensive, I want to make more money, I am going to raise my prices. It feeds on itself, and then you got a problem. But right now, the inflation should be really with the industrial companies, there's no, right? Nothing is being yes. Does anyone look at the 20 charts and found out where the bubbles are? Yes. You've had bubbles. You've had, I don't have the chart with me, unfortunately, but I will tell you that you have 1987. Let me see if I could get that chart for you. That's an interesting question, actually, because you have, well, let's put it this way. The market has crashed. Well, hold on, be careful. When we're saying we're in a big bubble, we are in a bubble. The S&P is highly valued, like I said before, right? The S&P is very valued, but it doesn't mean that the market is when the market is the S&P 500. That's what we're talking about. We're talking about the S&P 500. We're talking about the 7 biggest stock. We're talking Nvidia. Yes, Nvidia is richly valued. That is a fact. But it doesn't mean that the whole market is like that. I mean, let me just give me a second. Let me explain to you in terms of stock market, the valuation and how much much more valuation we have today versus then, right? If you look at the P/E ratio in 1999 to 2000, like the Nasdaq had a P/E ratio of 120 times. 120. Today, the quote-unquote AI boom is 30. So we are nowhere near. I mean, I know you when you read the paper, bubbles, bubble bath. We don't have that kind of valuation for the P. The price to sales ratio, it used to be at 20 to 30 times, and Nvidia. If we're going year-over-year growth and the Dow, the market is going, well, the market is up, but I mean, it's not as, again, it's up in the U.S., but the U.S. is not beating anyone right now. They're doing much better in Europe and in Germany. So I could hear the rumbling, the bubble, and we're overpriced. Yeah, this is all newspaper stuff. In reality, I'm not seeing that. You have to understand that it depends. If you're looking at Bloomberg, in Bloomberg when it was a Democrat, right? So obviously they're going to pump up stories that says, oh, nothing is going right now. It's horrible. The market is over. You got to be careful what you're listening to. Yes, the P ratio, you're not overvalued. The price to sell, same thing. Now, the only time where you could say that, in fact, it is overvalued, if you look at the market cap to GDP, in the dotcom era, yes, the U.S. market was if you take the U.S. market cap over the capitalization over the GDP, it's 150%. This is a Buffett indicator, they call it. And for the AI today, it's 180% to 200%. So to that end, there we are overvalued. Correct. In terms of market cap to GDP. But again, not the entire market is doing AI. Just 7 stocks. And remember, those 7 stocks, they just didn't start doing AI like the dotcom. Let's do dotcom. Let's do pet.com. No, this is different. That's exactly my point. If other economies are doing better than the U.S., so the actual value is purely inflation, not real growth. That's an interesting point, I have to say. Yes, it's exactly. They're doing better than the. Well, yes. Well, the U.S. took a beating at the beginning of the year, so that took a hit. So the actual value is purely in. Well, should you pay that? Should you be paying that much? That's, I mean, should you be paying, even you could look at the PE ratio today at 25, 30. Should we be even paying 30? Forget the fact that we used to pay 120 because we know what that ended up. Should you be paying 25 to 30 times? Should you be paying that on NVIDIA? I mean, NVIDIA is more. Should you be paying 115 times for Tesla? Is Tesla worth that much? That's a question, right? How much people are willing to pay? The only thing is, well, where's the money going to go, right? I mean, the money there's a humongous amount of money going into the money supply, and as long as they keep pumping money, it's got to go somewhere. You got to go into your 401k every year. Every month you need to invest. Where are you going to put it? In gold, Bitcoin. Okay, okay. When there's nothing to compare it, how can you be certain there is a top? I know. Well, is there a top right now? Well, if you're gonna go all the way to dotcom, we're not there yet. For in terms of P ratio, we are not there yet. When I say we, well, I'm talking about the S&P. And the S&P right now, if you look at the P ratio, is nowhere near what it used to be. And don't forget, when we're talking about the S&P, we're really talking about 7 stocks. Again, we're not talking about the entire market. Now, I know if they go down, they're going to drag a lot of stocks with them. And that's why I want to focus more on small caps. So at least, because last week when you probably were aware, but when Altman said, oh, there's a bubble in the stock market, stay away from it. Well, he didn't say stay away. There's a bubble in AI. The market collapsed, but not so much the Dow. So it feels more on the right side. Now, does this mean that you're not going to have a market crash? I'm not saying that, at least not tied to the AI. I mean, you could have a crash with the 7 stocks, right? But these are strong companies. You have low interest rates. Yeah, of course, if you look at the market cap to GDP, we are overvalued. But everything else, it doesn't feel that. And plus, rates are very low. And you don't want to be FOMO, fear of missing out. I feel that if people say, well, let's stay away from the market, you're going to miss out. Because this AI has more legs to go. Remember, AI is only like 3 years old, really, in terms of since this whole thing started taking off. While the dotcom was like 5 years, right? I think that what you're looking at is really the ability for everyone to understand what is happening. And the concern that I have, right, in terms of a potential issue is, the way geopolitical issue is a concern, or the tariffs, but not the tariffs in terms of the impact on the economy, but because the economy is strong, they'll take okay, fine, you're spending $1. I used to spend $1.15 on Nespresso cups. Now it's like $1.35. So it went up like 15%. It's more, but it's not. I'm not gonna buy the coffee. It's not gonna make a dent, right? Just don't go to Starbucks. Just make your own coffee. I mean, but we're not there yet, and you have to be careful what you're listening because lots of people will tell you it's the end of the world. It's not. Of course, if the federal, if 2 things you have to look forward is this thing with the Supreme Court is going to be a potential issue because I don't know what they're going to decide. But if they decide to, if they say no, not that it should be a big surprise, but it's going to be a disappointment. And if it's a disappointment, You don't know how they're going to react. Then now you have to give the money back. See, it's the whole the look. Your strategy was wrong. You got to give the money back. Then of course they're going to say, but hold on, you've been holding like $40 billion for like 6 months. You're not paying interest on that. You got to give the interest. You held my money for no reason, so now you got to give the interest. The money's got to flow out of the treasury. Now, obviously, when Pete Navarro said, yeah, gold, of course, and that's why it's going higher and higher. When Pete Navarro said yesterday, it's the end of the world if these 9 people don't say yes, you could see they're being pressured, right? That was Pete Navarro's idea, this whole tariff thing, right? Is the government going to follow him through? I mean, remember at the beginning they were following what's his name, Musk, and look what happened to him. Where is he now? Where is Musk? Right? I'm feeling I don't know if they have too much love for Navarro right now, and he's getting desperate. So when he's out there saying it's the end of the world, well, I mean, although even Trump himself said it would be like 1929 all over again, I would be concerned, right? That you don't want 1929, but really that bad? I mean, that quick and that bad? I don't know. I mean, right? I mean, blocking U.S. tariff. I think they trying to threaten the Supreme Court now. You're going after the Supreme Court, and if they say no, you're going to say they're biased. It's going to be very very difficult to say that the Supreme Court is biased. Because you can't usually create the amount of consumer in a market. Yeah, but right now we've got the consumer is strong in the U.S. Right? The stock market does not like uncertainty. That's the thing. It doesn't. I mean, they'll take a hit and then they'll come back and recover. So there's a lot more positive things that I think are going to happen going forward. But you have to make sure you have to separate the noise, right, from the facts, right? Because if you don't, then you go from the tariffs, Russia, you're all over the place, and then you get whiplash, right? And of course, if the consumer gets too much whiplash, too much uncertainty, then the consumer stops spending money, and then you got a problem. Because I will tell you, in the U.S., what drives the economy is the consumer. In fact, that's what China wants from the U.S. They want the consumer. They want you to buy those sneakers. They want you to buy all these things for now. Is that going to continue? I don't know. I mean, it's not going to end, tomorrow. Over time, we shall see. But you know what? As long as you invest smartly, slowly, gently, intelligently, right? Like, for example, right now, take a look at a bunch of small caps. Is it companies at P/E ratio of 4 or 5? Why you want to bother with NVIDIA for, right? There's a bunch of companies I recommended in my as a member. It's like $5 a month. And you get to see, right, in small p growth, right? Lots of things like that can be done. So you're not going to lose your shirt. You have to obviously, and this is what this channel is about, right? The channel is about monitoring the issues that we're facing, understanding them thoroughly, so you can make a decision. I mean, it's not just a stock market; it's job as well, right? Because if you lose a consumer, then you have a bit of a problem with the economy, and if you have a problem with the economy, then you're going to lose your job, right? So you wanna be aware of what's going on. I want to be aware of what's going on. I'm not saying, read everything and listen to everyone, but understand what's happening. Follow. Be careful you're listening to, because lots of people are saying lots of things all the time, right? But I mean, every day I look at the market and I send out a note. Like I said, I bought stocks because the market was down. That's the time to buy stocks, right? It's not the time to sell, it's the time to buy. Could you have a correction? Well, yeah, because the S&P is highly concentrated on those 7 stocks, right? And those 7 stocks are, but even then, when you look at those stocks, not that richly valued. So there's still something to be said here. Now, the thing you have to watch out, and we'll talk this afternoon around 2 o'clock, the Epstein file. That's going to be that's a very wild situation. The sanction on India is unjustified. Well, yes, a tough question. Yeah. Well, I will say this. Right. India. I first of all, I don't believe that the 50% are justified for India to stop buying oil. Why I'm saying that? Well, because they are basically you can't ask India, right, to not to get rid of 30% of its oil consumption, right? That's too much, right? That's too much. So what they are asking, I think, is a little bit too much now. So I think what needs to happen is, but that's not the reason they're doing it for. That's not the reason why the U.S. No, they have been negotiating with India for quite some times now. And what they want is even more difficult. The administration wants access to the agriculture of India. 40% of the people in India works in the field. They work in the field, and they're not like big farmers like in the U.S. Sometimes they have 4 or 5 cows or whatever, but it's 40% of them in the field. So, and India, correct me if I'm wrong, but India has 39% tariffs. If you want to sell agricultural good in India, it's 39%. So to that end, the administration is correct. It has a lot of tariffs. So they can't get in, and that's what they were trying to. And they were trying to get into that market, but Modi, I mean, it's not like him or don't like Trump or Modi's, they don't like each other, or whatever. It's not like that. It's just that they could not. If he gives up the farmers, he's gone. He'll have a revolution, right? And he'll be gone. So he says, Donald, well, what are you asking for? There's no way I'm never gonna agree to that, right? So I can't do it. Now, of course, is India gonna take a hit? Yeah, they're gonna take a hit. But again, be careful. India is, 25% is industrial. 20% is about the 20% is the agriculture, and then the other 60% or so is services. So, the way we trade in the market now has evolved over the past 6 years. Commission fees have been reduced drastically. Well, Nerosphere, I'll tell you one thing. That's not really true. Yeah, you don't have any commission or fees, right? But it's embedded in the bid and ask. So you're still paying. In fact, probably you're paying more. You don't see it though. Like when they buy at 10 and sell it to you at 10.3, there's a bid and ask, and they're getting some of that. So it's not free. But going back to Ajahn Singh's very interesting question is, yes, thank you. Well, I mean, I've been following this situation, and I understand Modi, right? I mean, Modi, what is he trying to do? I mean, he must be pretty desperate to get that close to China. You need to understand that China and India have been fighting a bunch of times. And the U.S. administration, it's not so much that they're pushing him to go. They've been getting closer to China very gently. Last year, they remove. They say, okay, let's stop fighting on that border because nobody's going to win. I mean, let's just agree to disagree, I guess. Then they allow these people to come over. Now you could fly back and forth because for a while you could not fly from India to China and vice versa. Only now did they. So these are not the best of friends. And Modi is, he's the only democracy in the area, and he was like a flank from the U.S. administration to be kept there. In a way, he's like a protection to. You don't want China and Russia and India together, and they're not really together. Okay, let's not get too carried away here. And what Modi is trying to do is trying to have his cake and eat it too. Hey, listen, he wants to make India great again. These people, the way you have to look at this is, these people have interests, and they're trying to see what's the best interest of their people. Now, of course, maybe wouldn't it be nicer if you could get your people out of the fields and into factories, right? So that you wouldn't hurt so much if the U.S. says, well, can I send you some soy or, right? I want my farmers to export as well, because then you'll be able to do that. But he hasn't done that. Well, then you can't touch them. Then what do we do then? And on top of that, you're buying oil from Russia, which frankly, why wouldn't you? I mean, it's cheaper. In fact, since they're trying to prevent it, it's been going up and up because it's getting cheaper and cheaper. And if tomorrow he decides to buy oil on the market, it's going to hit him from inflation point of view. Now, of course, then the question is the U.S. administration really doing it the right way? Right, that's the question. So, if Epstein files reveal major play in the market, do you think that they are heavily invested will sell and go into hiding? Well, let me tell you one thing, and I'll talk about more this afternoon, but there's 30,000 pages that just went out. Now, most of it is already public, and I think people are getting pissed. They say, okay, what are we doing here? You're releasing information we already have, right? You're letting that woman go basically into a better facility. Okay, fine. She released like 9 hours, but what did she really say, right? She didn't say much of anything. She basically said, I didn't do anything. This was a big misunderstanding. Really, I mean, you guys are exaggerating a little bit, aren't you? Because you mean nothing happened? No, nothing happened. It was just a misunderstanding. In this region, the U.S. needs a partner to counter China in the long run, and isn't good long. And yes, and irking India. That is correct. That is really true, right? Because India is a democracy, believe it or not. It's a democracy. China is not, and Russia is not. So, and the U.S. at creating this thing called the Quad, which was the U.S., India, Australia, and Japan, right? People tied to them. We have a China on our side and Pakistan hub on the right. And then, of course, Pakistan has been doing lots of overture to the U.S. administration, by the way. I'm sure Arjun Singh knows about that. And they've been quite successful. In fact, when China, and when there was this fight with India, the U.S. Trump basically said that be careful, right? You need to know exactly what they're doing, and basically the U.S. took credit for the peace treaty between the stop of the fighting between both the U.S. And that was kind of weird, right? And that didn't. Um, India wasn't too happy about that. Okay, so as you could see, we have lots of issues that are going on at this time, and that needs to be discussed. What else do we have? Well, this afternoon we'll talk about the U.S. Does a lot of public posturing, but once you pull back the curtain, you realize the wizard is working double time, just spinning the gears. I don't know what that means exactly, but I mean, yeah, I mean, well, let's see what's going to happen with Russia and Ukraine, right? Basically, the administration has said, all right, you got to stop fighting, otherwise, I'm going to do this and do that. Let's see what happens. Let's see if anything happens. Um, I don't know. Maybe they do something, or maybe they don't. But obviously, that relationship with Putin um, is not really there. All right, let's talk again this afternoon, and we'll talk about our friend Epstein again.